Moving to thing number two, Gary, we're sticking on the Fed. The Fed raises and tightens the dot plot here in thing number two of this week's five things.
Right. Well, so we got the CPI Wednesday morning at 8:30, and the Federal Reserve concluded their June meeting and put out their press release at 2 p.m. And so as soon as the CPI came in light, people started betting, hey, maybe the Fed will either lower the Fed funds rate at this meeting. They did not. They held. They kept the Fed funds rate the same. And the other thing that they were going to look at is the dot plot. Now, that can be a little confusing. Don't worry, we're going to put up a chart here. But the dot plot is done 4 times a year. And what they do is they take every member of the Federal Reserve, every governor, and they have them mark on a plot. Here's where I think interest rates will be at the end of this year, next year, the year after, and long term. And so we rolled into this year with expectations of 6 rate cuts. And then by the last meeting in April, that had been reduced to 3. And, the doves who had seen the weak CPI and the weak economic data last year, last week, came out and they said, hey, maybe the Fed will reduce that to, at least be at, 2 or 3 cuts. Well, that didn't happen either. The median went from 3 cuts down to 1, and the bottom of the range came up. This is a more hawkish Fed than the market believes right now.
Gary, what are we looking at? We started the year with expectation of six rate cuts, right? And then at the April meeting, they cut that in half to 3. You've got some people saying that there might not be any rate cuts for the rest of the year. Curious what the call is from DKI. When is this going to happen? What's going to happen? I think I'm familiar with what your take will be, but curious on specifics too, if we will get any rate cuts and potentially what that looks like and when.
Yeah, my answer hasn't changed on that from when we talked about it a week or two ago. I think at that time I told you if the Fed cuts, it'll be 1 and it'll be December. I just don't, unless the economy really falls off of a cliff, I don't see them doing that around the November election. Anything they do in September would come too late to provide stimulus that would help the party in the White House right now. And it would leave the Fed open to allegations that they were playing political favorites. It's something that they would like to avoid. There are a lot of people now saying that the Fed needs to cut rates now because the interest expense that we have is very high, right? I mean, we crossed $1 trillion this year, heading for probably 1.5, $1.6 trillion run rate by later this year. And so there are people saying, the Fed needs to cut rates. And I don't know that they do. Um, I think expecting the Federal Reserve to cut interest rates to accommodate a Congress that is overspending by trillions of dollars a year. I mean, they could do that. And, if you want to know where that ends where Japan is, right? Japan has gone from 102 yen to the dollar to, I think, 156, 157 yen to the dollar. It'll most likely, it was heading its way toward 160. That is, that's horrible. And so, yeah, can the Fed cut rates and bail out Congress and the Treasury? Sure, they could. But what will come with that is a huge amount of inflation. In the end, everybody's looking at the Federal Reserve, but the real people who need to solve this problem are the ones in Congress. In my opinion, this is a bipartisan problem. One of the things I should have grabbed it. Somebody on Twitter last week put up this great chart of U.S. debt for every president since Carter. And when you look at it, you realize there's sort of this belief that the Democrats are the ones overspending and the Republicans are the party of fiscal sanity and conservatism. And it is simply not true. President Reagan was a big spender. Both President Bushes were a big spender. President Trump was an enormous spender. And so this idea that we can vote out the people who are spending a lot, vote in other people and fix it, that's simply not going to happen. Republicans overspend as well. Debts and deficits go up during Republican administrations. So Basically, Congress needs to solve this. They're not going to, because there is no party right now in favor of fiscal restraint. So I think this problem is going to be with us. The question is whether Jerome Powell and the rest of the Fed wants to help solve the problem without Congress having to modify their behavior, or alternatively, um, continue with the Fed funds rate this high and continue to put pressure on Congress. And what this really reminds me of, Rob, is it's almost like being the parent of a kid who has a drug addiction. And the kid comes to you and says, I'm suffering, I'm going through withdrawal. I need money so I can buy more drugs because I'm in horrible withdrawal. And what do you do? Right? No one wants to watch the kid suffer, but having to buy more money, giving them more money so they can buy more drugs doesn't fix the problem either. And Powell's in that position right now. Lowering rates to accommodate an overspending Congress will simply extend the problem. And when we have to deal with it, it'll be a bigger problem. Now, whether he's willing to do that or not, I don't know. But again, this is a bipartisan problem. We cannot vote our way out of this. Whether you're on the left side with the Democrats, on the right side with the Republicans, there's nobody who's a voice for fiscal restraint right now. So something's going to have to give. I don't know that it'll be Powell. It could be, but I don't know that it will be. That's a really long answer to a simple question, Rob. Sorry about that.